it really checked all the boxes. Everything we could have hoped for in the jobs report we got this morning. So strong headline number. The unemployment rate held at 3.7%, but for good reasons, in that we got a big increase in the labor force to match the increase in household jobs. Wages ticked up. We're now above 3% in wage growth. We're at 3.1%. And we also saw broad-based job creation as well. So the goods part of the economy showing healthy growth in manufacturing and construction, but also services looking robust with some payback after last month's hurricane effects. So really across the board strength from today's data.
David, investors were paying close attention to the wage number, looking for signs of strength. We certainly got it. Fastest wage growth we've seen in a decade. How's the Fed likely to see that?
Well, I think they're going to see it as a reason to keep tightening. This is a strong report. It's not surprising. We've had two very strong back-to-back GDP quarters, and jobs follow GDP with a lag of 1 or 2 quarters. But this will keep the Fed on track. I mean, we've now got real wage growth for the first time in a long time, and that's a reason for the Fed to tighten in December, keep on tightening in March and June of next year. So I think this is not a good report for the bond market, but it's a good report for the economy.
Why do you say keep on tightening into next year? What do you think is in here that gives you clues as to a move beyond December?
Well, because we still have rates below where they think equilibrium is, and we've clearly got an unemployment rate below their equilibrium level. We've now got wage growth accelerating. So when equilibrium is when wage growth is stable. When you've got things actually too strong in the economy, it's when wage growth is rising. Now, it's nice for workers, but the Federal Reserve has to actually push against that a bit. So I think this will encourage them to keep on tightening, to get to a more neutral stance on monetary policy, because frankly, it's still pretty accommodative. They're still feeding this growth in the economy.
Michelle, we're just coming off of a very tumultuous month for stocks, as you know, one of the worst in years. And there were all sorts of calls out there that the economy was slowing. We've seen the peak. Some were even talking about a recession around the corner. Does it quiet some of those concerns to see a jobs number like this today?
Yeah, I think it does. Whenever you have big market moves, there's a search for the reason. And oftentimes that reason's, well, there's hidden weakness in the real economy, and the stock market is a leading indicator of that. But that's a difficult conclusion to make, and I certainly don't think that was the case in the past few weeks. It looks like we took some froth out of the markets, but we're still in an environment where asset prices are doing well, and the real economy is looking quite robust. So to me, I think it is certainly the case that we have growth to continue. We should see some slowing into the second half of next year, naturally, as the fiscal stimulus starts to diminish, as the Fed has brought interest rates higher, so you have some monetary tightening. So there's some slowing that we should anticipate, but by no means should we be expecting that a recession is around the corner.
I guess what I'm wondering really is, where does jobs fit in as far as a leading or lagging indicator? Isn't it sort of lagging? I mean, if there were to be signs of weakness, when would that show up, Michelle, in a jobs report?
Yeah, that's a really good point. Tends to see, certainly job creation lags a little bit relative to other economic indicators. However, there are labor market indicators that are quite leading, and one of those would be initial jobless claims. So that's probably my favorite indicator for trying to understand the turning in the business cycle. If initial jobless claims start to edge higher, that shows signs of some stress in the labor market, some pickup in firing, and that would be an area of concern. We're not seeing that by any means. Jobless claims have held at very low levels, which is supportive of what you're seeing broadly with labor market indicators.
David, it's been said that next week's meeting is a non-event, but is there anything in there that might give us clues as to what December could bring?
Well, yes. I mean, this should keep a December rate hike on the table. But the one thing I would sort of caution people about here is we got over 700,000 people added to the labor force. That's 1.4% year-over-year growth. That's great. It's not likely to be sustainable. We've actually seen declining immigrant visas for a third year in a row here. So we're gradually seeing a labor squeeze here. And one of the things I do worry about after the election is if we get, say, tax cuts 2.0 or a big infrastructure bill, we really don't have the workers to handle that. So I do think this labor market's tightening. We didn't get that in the full in the unemployment rate today, but I think that's coming. And I think the Federal Reserve will be a little bit worried about that. I think they're on track to tighten in December.
So, David, I'm just watching the stock market reaction here. We're losing a bit of steam. Yes, Apple's weak. Dow's up 90 points off the highs. Are we in a world where better numbers like this foreshadow more Fed tightening, which is not going to be taken well by the stock market?
Well, possibly, but if you look at the earnings season, we're up about 29% in year-over-year operating earnings per share for the S&P 500. That is phenomenal. And at some stage, I know the stock market's supposed to be forward-looking, but I do think to some extent investors have to digest just how extraordinarily strong earnings are right now and the ability that gives firms to distribute cash. So, I realize it's been a very rough October, but I feel, basically I think the sun is still shining here. I think there's still time to make hay in the stock market. I think there's still gains to be made here.